Hello, welcome to Fund in Focus, a series where we review ARK's funds and ask questions that might be on advisors' minds. I'm Brett Winton, ARK's chief futurist, and with me I have Tom Stout.
Thanks, Brett. I am going to play the role of asking Brett the hard questions that might be on your mind and trying to delve deeper into the funds, including for today, ARK's FinTech Innovation ETF, ARKF.
The FinTech Innovation ETF is focused on, really we think of three disruptive technologies, each of which is catalyzed by artificial intelligence. Digital wallets, which you can think of as the phone you have in your pocket and its ability to facilitate transactions in any context, and anything that shrinks the friction in transaction facilitation. Cryptocurrencies, we're all familiar with Bitcoin. We really think this is a monetary revolution that's changing the way that money is going to work worldwide, playing out over multiple decades, and smart contracting protocols. And these are blockchain-enabled auto-executing contracts that can really upturn the traditional financial ecosystem. So the holdings in ARKF all have some exposure and are either catalyzing or catalyzed by those three technologies.
So that's an interesting point because, even in the name itself, fintech, financial services, technology, those are two of the traditional sectors, that advisors and investors think about their allocations to. But when I look at the fund and you break it down, it is technologies 35 to 40% historically. Communication services is another 20-30%, and you have financial services in about roughly that range as well. So you have really three sectors that are meaningfully represented. It looks nothing like the technology benchmark that Morningstar puts against it. So how would an advisor, how would an investor think about where it fits in their portfolio allocation as a result of the fact that it's really kind of three things in one?
Well, the way I think about it is that across all the disruptive technologies, you need to have a meaningful exposure. The fintech set of technologies is disrupting the traditional financial services sector. So a lot of people have actually meaningful exposure to retail bank branches, for example. And so those retail bank branches are being disrupted by digital wallets like that Block has in its Cash App. That, depending upon how you measure it, is the second largest consumer-facing financial institution in the U.S. as a number of active customers exceeds what JP Morgan has across its huge network of bank branches. And, our belief is that those digital wallets are actually going to become the front end to people's financial lives. Why? It used to be when you selected a bank, you looked around and you're like, oh, there's an ATM there. That's how you decided where you were going to bank. That doesn't matter anymore. And so there's literally, it's billions and billions of dollars of bank branches throughout the U.S. that we think are essentially sunk cost assets that are no longer going to produce kind of the returns they need to. And that economic flow is going to move towards these digital wallet providers.
Let's address what has certainly been the topic of every conversation when looking at equity markets and certainly financial markets, and that's the interest rate environment that we're in. It's pretty common for the conversation around financial services, the sector, mostly dominated by the large banks from a market cap perspective, to have the conversation about the impact that falling rates will have given their loan books. How should investors think about the impact of a changing rate environment on fintechs, though, perhaps differently than, say, large banks?
Yeah, I would expect actually the fintechs broadly to have either neutral or moderately positive exposure to falling rates, whereas banks, I think, would be negatively impacted. Right now, essentially, the very large banks aren't having to pay out meaningful interest to their depositors.
That's right.
But they're able to collect the benefits of that interest.
That's right.
In
They're
their
yielding
loan
it.
book. Yeah. And fintechs usually don't have that business model. It's not their primary business model. Instead, for instance, the Cash App, it's mostly transaction facilitation. So interchange on debit. So then as the interest rates, and then they also sell a lot of Bitcoin. And so as interest rates fall, which we anticipate that they'll do, you should have price appreciation across the crypto asset landscape, which should help these companies that have crypto exposure and are providing other financial service functions.
So even if the thesis was as simple as, I like the financial services sector, I'm overweight, you could argue there's a strong case to be made for making sure that some of your financial exposure is in this for that exact reason, that they're not going to be as exposed to declining margins on effectively arbitraging the interest rate spread.
Yeah, exactly. And I think it's actually a good way to hedge risk. As in your core portfolio, you have all these bank branches. Well, say I'm right, and kind of digital wallets really serve as a penetration vector against those business lines. And it could be Apple's, could be Square's, could be Toast's. There's all kinds of these companies out there. It could flow through the Shopify channel.
Yep.
So the problem that you face as an investor that has like a core index position is suddenly the interest rate is moving against you and you're getting disrupted across those assets. And so you need to insure yourself against that risk. And that's why you take a good, strong fintech portfolio exposure to basically protect yourself against the downside risk of changing interest rates and disruption that we think is going to come.
Now, to address a question that I think naturally comes out of that is some of the names you mentioned are consumer-facing names. Certainly when you think of some of the rest of the portfolio, Shopify, Coinbase, Block, a lot of those have very consumer-facing aspects to them. What would you say in terms of the economic backdrop, you think about the impact on these names relative to where the economy is, and if the consumer gets hit disproportionately in a changing, not interest rate driven environment, but really just a different macro environment in the U.S.?
Yeah, so most of the fintech names, and almost across all of them, don't carry credit exposure on their book. So like you can imagine in a forward-going environment where, or at least within our portfolio, there are some, for instance, the buy now, pay later services. I think it'll be really interesting to see how they, and if they survive throughout this cycle. And we actually see that more as a feature, not a platform. And so don't have meaningful exposure to that in this portfolio. But for the most part, there's not credit exposure across the fintech names. And as with a lot of disruptive technology, the shaky macro environments cause people to make like changes in their life that tend to shift them towards disruptive technology platforms, not away from. And so, if you begin, seeing overdraft charges against you from your bank, you might be, I'm sick of this. I'm just going to direct deposit into the Cash App rather than dealing with this financial institution that has been, nickel and diming me as kind of like my income is struggling. And similarly, people will kind of look for those deals. They'll cut the cord, for instance, in linear TV, and that's what will shift them more into Roku's connected TV ecosystem. So I think with a lot of disruptive technology, when people, the competition is not against existing spend, it's against status quo. And so when you force people to make choices, they end up actually providing business to these companies that they otherwise wouldn't.
You mentioned a name there that I think could cause some questions. You referenced Roku, and I would really, looking at the portfolio, I'd add Roblox, perhaps DraftKings. These are not necessarily names that somebody might expect to find in a fintech fund. There's certainly a lot of names that very much would, but these are a little bit different. What are some of this other aspects or these other names that people might be surprised about, but why are they in the portfolio? Why are they relevant to fintech, and why are they driving some of the differences, over other fund construction?
Yeah, it really comes down to how we define digital wallets and how we think about kind of the value proposition of these services. So a fintech innovation is one that really reduces transaction friction. So take Roku. Roku right now, it starts out, it just makes money from having people sign up for Netflix through their service, and they have an ad-supported business model on there as well. The direction that the connected TV space is moving is going to be to directly facilitate transactions through that television. And so Roku's ability to do that is contingent upon everybody watching the TV and you getting these great kind of AI capabilities to identify the products and then surface them so consumers can instantly purchase them. And so it becomes the commerce platform. Roblox already is basically has a virtual currency that it uses to allow people to effectively make microtransactions for all of the services that are games that they buy on that platform. And then DraftKings similarly is a new mechanism by which sports can monetize. So if you look at kind of what the IP holders for like the NBA paid for all of the NBA content, it's up something like 3x versus the last contract. Why are they paying so much more? It's because now there's this whole new revenue stream that they can tap into that then goes into player salaries and enables the entertainment to be produced.
So, okay, one last kind of big category certainly is anybody who's been paying attention to the market would have to have had their head in the sand to have missed obviously the Bitcoin ETF, Bitcoin in general, blockchain, cryptocurrency. And so if I'm an advisor, do I really need to own fintech exposure or could I just buy Bitcoin or a Bitcoin ETF? Like, why do I need fintech in my portfolio if I have technology and I have Bitcoin?
Well, you can buy Bitcoin, and Bitcoin is represented as a portion of this portfolio. But if you look at the portfolio as it's currently constructed, Coinbase is actually larger. And the reason why is Coinbase is building innovation on top of the crypto asset platforms and really enabling the entire smart contracting space. We think that there's two simultaneous revolutions going on here. There's the monetary revolution represented by Bitcoin and cryptocurrencies. And there's this entire upheaval within the financial services landscape generally. And if you believe in Coinbase's management wherewithal, they'll be able to enjoy the beta of crypto, whatever crypto appreciation occurs, which we think it will, and build an amazing business on top of that, serving as really the preeminent financial institution in kind of the new age of crypto assets.
Okay, last one. I want to end with valuation. Right, valuation always matters, and historically, fintech has had an outsized multiple relative to even technology as a whole, given the nascent stages, the high growth rates, the geographic nature of fintech, and also the disruption of multiple industries at the same time compared to a benchmark that wasn't involved in that. But we've looked at we're at a place now where ARKF is effectively, while strong in the last year, is in a basing period for about 2-3 years. It is at a point now where the price to sales for the portfolio is half the technology average, and really even on a price to earnings ratio, it's almost category flat. It's about the average of the portfolio, almost the same as the technology in general. What has the market been digesting that it's come back in on a relative basis, and what's the catalyst that really sends fintech? If you're looking to add exposure now, what's that catalyst that's going to really have that breakthrough on both a relative basis to the rest of technology, which is certainly some parts that have seen a run here, but also just on an overall absolute basis?
Yeah, I think what's happening in artificial intelligence right now is accelerating all of the technologies that we look at. And kind of these fintech companies are more agile, aggressive, and innovative. And so they are adopting artificial intelligence to kind of accelerate the products and services that they're able to offer, and will do so kind of at the expense of their traditional competitors. And so you're right. Historically, it trades at a premium. Now it trades at a discount. That's a strong sign that, hey, you can get good value here. And the interest rate environment certainly hasn't helped these companies as it has hurt, all innovation companies. I think you can make a strong case that any marginal change in the innovation in the interest rate environment will not only benefit these companies in terms of driving customers into their favor and driving top line growth, but also cause kind of like investors to shift allocations. And so where it's been great to sit in a large cap bank for a long time, right? And so kind of a change in these companies' favor will really cause kind of fintech companies to thrive.
We want to thank you for watching along with us for Fund in Focus for ARKF, the ARK FinTech Innovation ETF. As always, you can learn more information on the website at www.ark-funds.com. We appreciate paying attention. We look forward to talking again with you soon.